Hello and welcome to CNN Vantage Point. I'm Philip Pro, Chief Investment Strategist with CNN Wealth Management. In today's podcast, I'll provide a market review for the month of December 2024 and our current outlook. Equities began the month continuing November's post-election rally, but ultimately faltered to limp into the new year. On December 6th, the S&P 500 index closed at 6,090, its 57th record closing of 2024. But the rally stalled after the Fed projected just 2 rate cuts in 2025 as opposed to its previous projection of 4. This led the index to move back to its narrow mega-cap momentum trade and away from the broad-based trade seen since the election. Only 3 sectors, technology, communication services, and consumer discretionary, ended the month with a positive total return. It's those 3 sectors where the Magnificent 7 stocks reside, which is the mega-cap momentum trade. Meanwhile, the other 8 sectors finished the month with an average negative return of 7.95%. The largest decline was in the materials sector, which had a negative 10.72% return in December. In total, the S&P 500 index declined 2.4% in December and closed 2024 at 5,882 for a yearly return of 25%. This marked the second consecutive year the index has returned in excess of 20%, a feat last seen in 1998 and 1999. The prospect of fewer interest rate cuts impacted other indices more intensely. The small company Russell 2000 index and the Russell Midcap index lost 8.3% and 7% respectively. The Russell 1000 Value Index lost 6.9%. Similar to the S&P 500, Bitcoin elevated to start the month, exceeding 100,000 for the first time ever. But like the S&P 500, it ultimately fell and ended with a monthly decline of 3.84%. Bond yields rose on the expectation of fewer rate cuts in 2025. The 10-year Treasury yield briefly moved back above 4.6%, but finished the year at 4.58%, an increase of approximately 0.75% in the fourth quarter. Technology was the bright spot in December, as the tech-heavy NASDAQ Composite Index managed a 0.6% return and briefly crossed the 20,000 price level. Coming into the new year, there remains mixed signals throughout the markets and the economy. Some business metrics are weakening, while others show strength. But it's the possible resurgence of inflation and higher for longer interest rates that have taken center stage for market concerns. Having mixed signals is common, but through all the noise, we still believe the key for 2025 will be earnings, and we believe earnings will be strong enough to keep the bull market in place. Most analysts are projecting earnings growth for the S&P 500 to be in the 11 to 13% range. While we expect choppy markets as President-elect Trump's policies begin to be fully revealed or implemented in the first few months of his term, we expect companies will adapt, earnings growth will remain positive, and ultimately markets will follow. Barring any unforeseen event, we expect the Fed to be slow in the rate cuts, keeping the 10-year Treasury range-bound at its current yield plus or minus 25 basis points for the first half of the year. Overall, we're positive on equities and made no positioning changes in December, maintaining our 1% overweight to equities with a tilt towards U.S. equities. We'd like to remind our listeners that market conditions can change quickly. As circumstances and facts change, CNN Market's views and portfolio positioning may change accordingly. If you would like more information about our current positioning and market thoughts, please contact any of our wealth management advisors. If you like this podcast, we'd be grateful if you share it with your friends. On behalf of the entire CNN Wealth Management team, we thank you for listening.
Please note, views are subject to change based on market conditions and other factors. These views should not be construed as recommendation for any specific security or sector. Client portfolios may or may not be at the positionings discussed due to, but not limited to, distributions, tax management limitations, systematic purchases, etc. Some products are not FDIC insured or guaranteed, not a deposit or other obligation of the bank, not guaranteed by the bank, and are subject to investment risk, including the possible loss of principal amount invested, and are not insured by any other federal government agency.